Welcome back. This is the deep dive, and we are really ripping up the playbook today to figure out what happened in the market last week.
And more importantly, what it all means for your positioning in this, well, critical holiday-shortened week coming up.
Exactly. We're diving into a huge stack of analysis, and it all seems to point to one thing: a stubborn, neutral market mood.
It's true. We've had volatility, we've had strong economic signals, even some dovish talk from the central bank, and yet caution is still the word of the day.
So our mission is to get past the headlines and really uncover why. Why are professional investors sitting on the sidelines when you've got the Fed talking about rate cuts and GDP growth looking so strong?
That caution is the whole story. The market's caught in a dilemma, isn't it? It's between the hope of easier policy and the reality of, slowing momentum.
Right.
And if you're getting ready for this low liquidity week, understanding that neutral stance is absolutely crucial.
Okay, let's start with the immediate past then, because the week ending November 21st, that was a bit of a wake-up call.
It really was. After a pretty calm period, we saw a distinct pullback right across the board.
And the numbers don't lie.
Not at all. The S&P 500, it finished the week down about, 1.9%? And the Dow lost around 1.5%. These aren't just minor dips. They signal a real shift in psychology, especially what we saw late in the week.
So what was the trigger? The analysis we've seen is pointing a finger at profit-taking, specifically in those high-flying stocks.
Precisely. The volatility really boiled down to skepticism around the high-growth sectors.
You mean AI?
AI-related investments, absolutely. Investors weren't just, taking a few ships off the table. They were fundamentally re-evaluating the valuation models themselves.
But why now? I mean, we've been talking about the AI growth story for months. What changed?
I think it speaks to the late cycle feel of this whole rally. When growth is easy, everyone chases momentum.
Sure.
But as the macro picture gets a little murky, and we'll get to the manufacturing data in a second, investors start asking the hard questions.
Like, are these massive valuations sustainable?
Exactly.
Yeah.
Or are they banking on just perfect execution forever? And for a lot of them, the answer last week was no. The risk-reward just didn't look good anymore.
So we're seeing money move out of that expensive growth and maybe into more defensive quality names.
Which leads us right into this tug-of-war theme.
How can we have a pullback like that if the economy underneath it all still seems so strong?
Because the market never prices today. It prices tomorrow. It's wrestling with strong recent data versus some concerning forward guidance. And that conflict is why no one is committing one way or the other. It just reinforces that neutral mood.
Okay, so let's break down that tug-of-war with the actual data. On the one side, you have this incredible resilient growth. Q3 2025 GDP estimates are still hovering near 4% annualized. I mean, that's just strong.
It is. It shows that the consumer and the services side of the economy have been just extraordinarily hard to slow down.
And the PMI data backs that up.
It does. The composite PMI, which, tracks both manufacturing and services, it actually rose to 54.8.
That's a healthy expansion.
A very healthy expansion, driven almost entirely by that massive services sector.
So if services, which is the biggest part of the U.S. economy, is booming, why is the market so worried?
Because when you look under the hood, you see the weakness starting in the manufacturing core. The forward-looking flash U.S. manufacturing PMI, it dropped to a 4-month low of 51.9.
Now, that's still expansionary, technically.
Technically, yes, but the signal is unmistakable. The factory floor is softening. Deceleration is happening. It's just happening slower than maybe some people expected.
And this is the growth inflation tug-of-war you mentioned.
Yes.
Services running at 60 miles per hour, manufacturing slowing to 30. How do investors position for two different economies at the same time?
It just creates hesitation.
Yeah.
Strong services could mean sticky inflation, which is bad for bonds. Soft manufacturing could mean a hard landing, bad for stocks. The neutral mood is just the mathematical average of those two fears.
And then the Fed complicated things.
Well, you had Governor Christopher Waller, who's a very influential voice, give a speech all about the case for continuing rate cuts.
That's a huge dovish signal.
It's a clear tailwind, for sure. But the market couldn't really price it in properly.
Why not?
Because the one piece of data you need to confirm that move was missing.
The October CPI report.
The October CPI report. It was delayed because of those government disruptions.
Leaving the market flying blind on inflation.
Absolutely. Think about it. Waller says cut rates, which suggests inflation's under control. But without the CPI print, traders can't confirm that. Are we cutting because things are great or because they're about to get bad? That uncertainty vacuum just mutes the whole signal. Which brings us to the core strategic narrative for right now, the long-term pivot. It's about navigating this neutral zone between policy easing on one side and these persistent fiscal headwinds on the other.
Okay, so what does the market need to see to break the tie? What validates that soft landing scenario that the Fed seems to be aiming for?
We need to pass what we're calling the easing validation test.
Easing validation test.
The market needs to see incoming data from everywhere, not just the U.S.
So things like European sentiment indicators, that kind of thing.
Exactly. Data that proves the Fed's October rate cut actually worked, that it secured a soft landing, not just reacted to a sharp drop that was already underway.
So if that soft landing gets confirmed, where do you start looking for opportunities?
In that scenario, the playbook would suggest you can start to modestly add exposure to high-quality credit.
Okay.
And maybe selectively look at some early cycle industrial and materials names, especially in places like emerging markets where they're already cutting rates pretty aggressively.
But hold on. If the Fed is dovish, why aren't we seeing a huge rally in everything, especially long-term bonds? This must be where those headwinds come in. The quality and duration dilemma.
That dilemma is maybe the most important concept for you to understand in fixed income right now. It explains why the old buy everything response to a dovish Fed is just completely flawed this time.
Walk me through that. Why doesn't a rate cut automatically send long bonds soaring?
It's because of fiscal dominance. While the Fed is cutting on the short end, the government is still issuing massive amounts of new debt to fund its deficits.
All that supply.
All that supply of long-dated bonds keeps long-term yields stubbornly high, no matter what the Fed does with its overnight rate. The market is demanding a premium to hold all that paper.
That makes perfect sense. The supply of new bonds is just overwhelming the demand you'd expect from a small rate cut.
Exactly. So for your equity positioning, it means you have to have this laser focus on secular growth leaders.
Companies with pricing power, clean balance sheets.
The ones that don't need cheap debt to grow. The advice is to really underweight those high debt, high beta cyclical stocks. The outlook is for slow, steady growth, maybe 1.8% year over year. That backdrop supports quality, not speculative bets.
And for fixed income, it means you stay cautious on the long end of the curve.
Absolutely. You maintain a short to intermediate duration bias. You have to treat long-dated bonds with extreme caution right now because that fiscal risk, it's just not fully priced in yet.
Okay, so let's look forward. The week ahead is critical, but it's also structurally tricky. We have the Thanksgiving holiday.
Right, so a closure on Thursday, short day Friday. Thinner trading volumes are a guarantee.
Which can mean outsized moves.
Outsized reactions to any data, any news. And that's amplified even more by the fact that we're in the FOMC blackout period.
Right, which means no speeches, no guidance from any Fed officials all week.
None. The market completely loses its monetary policy compass. All the price-setting influence shifts to the scheduled economic releases.
Okay, so let's run through those. Monday, November 24th, we start with some regional checks.
Yeah, the Chicago Fed National Activity Index and the Dallas Fed Manufacturing Survey. These will give us an early pulse check on whether that manufacturing softness we saw is getting worse or stabilizing.
But the main event is Tuesday, the 25th. This is the big one.
This is the must-watch day, headlined by the Consumer Confidence Report from the Conference Board.
And why is that so crucial right now?
It's the tiebreaker for the outlook. I mean, consumer spending drives this economy, and as we head into the holiday shopping season, we need to know that households feel confident enough to spend.
A bad number here could really change the narrative.
A significant miss to the downside. It instantly shifts that soft landing story toward a harder, faster deceleration. That would put huge pressure on retail and cyclical stocks.
And Tuesday's also packed with some really key earnings reports.
A powerful trio, actually. You've got Alibaba, which gives you a window into global e-commerce, and importantly, the health of the Chinese consumer.
And Dell.
Dell is your bellwether for corporate IT spending. Are companies still investing in tech? Or are they freezing budgets?
And then bringing it right back home to the U.S. consumer, we have Kohl's.
Kohl's is the perfect read on that mid-tier retail sector. It tells you how sensitive shoppers are to discounts. Are they still buying discretionary goods? Or are they really tightening their belts? The story from these three companies will be huge.
So to pull it all together, the strategy for now is to stay neutral, wait for that critical data on Tuesday.
Right. But there's a geopolitical factor we can't ignore, something analysts are calling the trade truce fragility.
This is about the recent U.S.-China detente.
Exactly. That framework agreement from October and November, It temporarily eased a lot of the trade tensions. It was a relief valve for global supply chains.
But the key word in your phrasing there seems to be fragility. Why not just see it as good news?
Because it's a temporary pause in a long-term strategic rivalry. It's not a fundamental fix. We've seen how quickly things can escalate. Those structural disagreements, they haven't just disappeared.
So from an investment standpoint, how do you play a temporary thaw?
You look for selective opportunities in multinational companies that have already built diversified supply chains.
So they benefit from the current relief, but they aren't totally dependent on it.
Precisely. A company that has already moved some production to Mexico or Vietnam, for example, they get the benefit now, but they're also structurally hedged if tensions flare up again. You just want to avoid overexposure to any firm that is completely reliant on this fragile relationship holding.
That's a sharp point, especially in a low liquidity week. What's your final warning on risk management?
Discipline. You have to be absolutely cautious about chasing any big moves in the second half of the week.
Wednesday, Thursday, Friday.
Yes. Thin markets create exaggerated swings, and liquidity can just vanish, trapping you in a bad spot. Stick to your plan. So the takeaway is, you should see this as a controlled deceleration, supported by a Fed that's ready to cut. Last week's pullback is a selective opportunity, but you have to focus on balance sheet quality and pricing power. That's what will win against this backdrop.
Which brings us to that final provocative thought, the big question you should be mulling over. Considering this quality and duration dilemma, right? If inflation just stays stubbornly close to target into 2026, how much longer can those long-term bond yields keep rising before they become a truly unmanageable fiscal risk?
A risk that could effectively force central banks to choose between market stability and just being able to service the national debt.
That's the big question. Thanks for diving deep with us. Use these insights to map out your moves for the holiday week.
Stay data-driven and get ready for Monday.